Hi, everybody, and welcome back to video number 2 on Chapter 6. And when we left off, we were looking at variable consideration, in this case, trade discounts. This is a reduction from the list price, trade discounts. It's not recognized in the accounting records. Customers are billed net of discounts. And we show this guy with a 10% discount for a new retail store customers. Okay, now we have another kind of discount, and this is called cash discounts, sales discounts. I call it prompt payment discounts. And prompt payment discounts are an offer to induce the prompt payment of an invoice by our customers. So it's presented in terms like this: 210 net 30, meaning that you get 2% discount if you pay within 10 days. If you don't, you're required to pay within 30 days. We could also have 210 and then end of month, or net 30 end of month. So we have a gross method versus a net method. So let's look at that. Here's an example. The Armor Company sells goods for $10,000 to O'Hara Incorporated on April the 1st with terms 110 net 15. How should Armor record this transaction using the gross method and the net method? So if we use the gross method, we're simply going to take this $10,000 and set it up as a receivable and record the revenue. Now, if it's a net method, we show the receivable assuming that the customer is going to take that prompt payment discount here, in this case, 1%. So 1% is $100, and we subtract that from 10,000 to get $9,900. Okay, so then what do we do? So if the discount is not taken, the Hanley Company has the following transactions with Murdoch Incorporated. Hanley sells goods for $10,000 to Murdoch, terms 210 net 30 on March 1st. On March 8th, they receive a payment of $3,920 from Murdoch related to that sale. On March 26th, Hanley receives $6,000 related to the sale on March 1. What entries should Hanley make in March regarding that sale to Murdoch using the gross and net method? Well, if we do the gross method, the one I'm most familiar with, we're going to debit accounts receivable and credit sales revenue. Of course, it does imply that accounts receivable are going to be collected to the tune of $10,000. However, it's not quite. Okay, so in the first payment, we got cash of $39.20, and that was calculated by taking the 2% here of the $4,000 that they did pay, and that gave them an 80% sales discount as a debit. Then they owed a remaining $6,000, and so we debited cash for $6,000, credited accounts receivable. You'll notice that accounts receivable is zeroed out in this case from this debit of $10,000 here. Now, if we use the net method, the assumption is the customer is going to take the discount. So we record it with a 2% discount removed from accounts receivable. So initially they paid $39.20, right? And that already had the 2% discount removed. But then they paid another $6,000 in cash. We had a remaining $58.80 in accounts receivable to hit the $9,800 here, but they did not take the sales discount on that $6,000 of 2%. So they forfeited that $120. Okay, so under the net method, the net revenue is shown in operating income while the $120 of discount is shown in other revenues and gains below operating income. Okay. Under each method, of course, the total increase to net income was $99.20. Okay. Variable consideration here, sales returns and allowances. It's a contra revenue account. It's shown on the income statement right under, call it gross sales, and we subtract sales returns and allowances from sales to get to net sales. And so it's a subtraction here, a contra revenue account. There is an allowance for sales returns, and allowance is a contra asset to accounts receivable. Okay. And then we're going to use both the sales returns and allowances and the allowance for sales returns and allowances accounts. That's helpful in identifying potential problems associated with inferior merchandise, inefficiencies in filling orders, or delivery or shipment mistakes. So if we have a sales return, that's bad. If we have a sales allowance, that's bad. We want, if we're investigating that, which we often do as managerial or for that matter financial accountants, that pinpoints where we want to go look for opportunities to improve in the future. Okay, so here's an example here. Polaroid on January 12th sells 100 cameras at $100 each to Target. Polaroid allows Target to return any unused cameras within 45 days of purchase. The cost of each camera is $60. Okay, Polaroid is going to estimate that 3 cameras are going to be returned, and the cost of recovering the products will be immaterial. So the returned products are still good cameras, and they're expected to be resold at a profit. So on January 24th, 12 days later, Target returns 2 of the cameras because they were the wrong color. On January 31, Polaroid prepares the financial statements and determines that it is likely that only 1 more camera will be returned. So, what entries does Polaroid make to record the sale on January 12th and the related sales returns and allowances? So, initially, what we're going to do, 100 cameras times $100 is $10,000. So, we'll debit accounts receivable and credit sales revenue. At the same time, expense recognition principle will record a debit to cost of goods sold and a credit to inventory because those cameras went out the Polaroid's factory to Target. Now, on January 24th, we're going to record that 2 cameras worth $100 each are returned. So we hit sales returns and allowances, which is a contra revenue account, and we reduce accounts receivable by $200 as well. The inventory is returned to stock, good cameras, and cost of goods sold is reduced by $120 because we didn't incur those costs. Pretty straightforward there, I think. So the adjusting entries for estimated returns. So if we look back at what we just did in the previous slide, we're going to assume that Polaroid is now ready to prepare financial statements at the end of January. Polaroid originally estimated that the most likely outcome was that 3 cameras would be returned, but Polaroid believes the original estimate is correct. Therefore, they expect 1 more camera to be returned. What adjusting entries should Polaroid make to account for that expected return? So what they would do is they would pretend like it was returned. We'll debit sales returns and allowances, but the credit in this case is not going to be to, as you remember over here, accounts receivable, right? Instead of accounts receivable, we're going to credit refund liability, a liability we think that will occur because of that, because we need to refund that returned item. And then we're going to debit estimated inventory returns here and a credit to cost of goods sold. So the refund liability account is a liability for future returns. The estimated inventory returns account will generally be added to the returned inventory account at the end of the reporting period. Okay, time value of money. Theoretically, any revenue after the period of sale is interest revenue. Companies ignore interest revenue related to accounts receivable because the amount of the discount is not usually material in relation to net income for the period. Profession specifically excludes from the present value consideration receivables arising from transactions with customers in the normal course of business, which are due in the customary trade terms, not exceeding approximately 1 year. All right, so here we'll take a look at Max Glass. And here, Max Glass sells some hurricane glass to Oliver Company. The cost of the glass is $3,000. Max records the sale on account and records the cost of goods sold. Okay. On January 16th, they grant an allowance of $300 because some of the hurricane glass is defective and was discarded by Oliver. Discarded. So this is not good inventory. And then on January 31st, before preparing the financial statements, Max estimates that another $100 in allowances will result related to its sale to Oliver due to defective glass. Okay, we're going to prepare the entries for that. And initially, we're going to record a debit to accounts receivable and sales revenue, and a debit to cost of goods sold and inventory, standard entries there. But then because of the damaged hurricane glass, we're going to debit sales returns and allowances and credit accounts receivable. Because of that, you will notice that nothing has affected inventory here because that was bad product that could not be resold. And then to adjust for estimated allowances, again, we'll hit sales returns and allowances and refund liability here. All right. So as a result of those transactions, Max is going to report net sales revenue on the income statement, $5,000 less $300 less $100, right? Which is what they expect from the sale of the glass. And in addition, Max is going to report on the balance sheet the receivables here of $4,700, which is the $5,000 less the $300, and a refund liability of $100. The use of both the sales returns and allowances is helpful because we're going to look for problems. The hurricane glass were returned instead of an allowance provided. The entries record the cost of goods sold. So here our returned inventory, $180, cost of goods sold, $180. Estimated return cost is $60. And cost of goods sold as a credit is going to be $60. Okay. That looks like a good place to stop this video. And when we return, we'll take a look at our next learning objective. Until that time, bye for now.